Welcome to the world of investing. Whether you're a novice or an experienced investor, there's always something new to learn. So let's dive into the basics and explore this fascinating journey together. Investing is a journey, not a destination. My journey began earlier than most. I bought my first stock when I was just 11 years old, but before that I dabbled in stock market theories, charting patterns, and market timing, only to realize most of it was profitless fun. It wasn't until I discovered Benjamin Graham's book, The Intelligent Investor, in 1949, that my entire philosophy shifted. One of the most profound lessons I learned was viewing stocks as businesses. When I first started, I memorized ticker symbols like a game, knowing that X was US Steel and T was AT&T, but I had no idea what those companies actually did. Graham's book changed my perspective. Investing isn't about following charts or patterns. It's about understanding a business's fundamentals. What does the company do? What are its economic advantages? Who are its competitors? Instead of chasing short-term stock movements, I started asking, is this a good business? The stock market is unpredictable, driven by emotions, speculation, and short-term news. Most investors react to price movements as if the market knows something they don't. Graham introduced me to the concept of Mr. Market, a metaphor for the stock market's manic nature. Imagine you own a business with a partner who, every day, offers to buy your share or sell his at a new price. One day, he's euphoric, offering a high price. The next, he's panicked, selling for far less. The key? You don't have to respond unless the deal benefits you. This simple idea changed everything for me. The market exists to serve you, not instruct you. Instead of reacting emotionally, I learned to be patient and wait for the right opportunities. One of the most critical principles in investing is building a margin of safety. If a bridge has a weight limit of 10,000 pounds, you wouldn't drive a 9,800-pound truck across it. The same applies to investing. Never take unnecessary risks. Buy with a cushion. Investors often focus too much on stock prices and not enough on business fundamentals. But a great business at an inflated price is a bad investment. A good investment is one where the value is clear and the price is right. Capitalism is brutal. Every successful business faces competition. That's why I look for companies with an economic moat, a lasting advantage that protects them from competitors. Some businesses have a moat due to strong brand recognition like Coca-Cola, patents and intellectual property such as those held by pharmaceutical companies, high switching costs often seen in software companies, and exclusive locations or distribution networks. When choosing investments, I don't chase trends. I look for businesses that can last for decades. If I could give one piece of advice, it would be this. Investing isn't about stock picking, it's about business ownership. The best investors don't chase prices, they analyze businesses, look for opportunities, and stay patient. And remember, you don't need to swing at every pitch. A few great investments in a lifetime can make you very rich.